Good afternoon, viewers. This is Mr. Bani, which is Sam.M from Great Impacts Multiventures Ltd. Today, we are going to be having some discussions in our financial literacy class. Now, I'm going to be talking about assets and liabilities. I'm going to be dealing with the conventional definition, and then I'm going to be explaining why that definition is not well encompassing enough in the real business world of today. Life is evolving, the economy is unstable, it's changing from time to time. Most of our definitions also have to be reviewed to capture the realities of the moment. Otherwise, we are going to continue to train our children to live in the past and not be able to meet up with the contemporary demands of the economy. The conventional definition of an asset is a property that is owned by a business in business terms. And that of liabilities is a property or properties that are being owned by that are being owned by others, and that a business is using. That is what you owe to others and you are using in your business. But you see, in reality, assets should be defined as properties that belong to a business and that are used for business purpose, which in other words mean not all properties are business assets. For example, if I have a house that I'm using for my business, that house becomes an asset to that business as long as I want it to be an asset to the business. Although in actual sense it's a liability to the business because the business actually rented it from me. But if I decide to convert it to my business assets, it's still fine. But if I have a house that I am not using for business purpose, then that property cannot be referred to as an asset in my business. It's a property. In fact, it's a fixed property, but not a fixed asset for my business because it is not owned by my business and used for business purpose. So we should be able to draw the line between what a business asset is and what a personal property is. So permit me to say that your first house as a business owner, if you don't use it for business purpose, then it is not an asset to your business. It is not. Because it's not going to be generating any business income for you. You are the one that is going to be spending on it. The only benefit is that it will help you to reduce your cost of living because at least that will take care of your rent that you normally pay to your landlords. But it will not bring in money for you. But if you want to convert that house to an asset, then you may consider converting part of it for rentage, or if it's possible, if God blesses you to be able to get it, you can rent it out and start using it for money, for making some income, some passive income. That's when it becomes a business asset. For liabilities, liabilities are what a business owes to others. But there are different categories of liabilities too. Unfortunately, in businesses, the one we recognize mostly are the financial liabilities. Financial liabilities, or machines and other things that we owe to others. We do not take note of human liabilities. There are also human liabilities. Human liabilities. Okay? In business terms, what actually is a liability? What you owe to others and that you are using to make business income. That's a liability. Then who are human liabilities? Human beings, maybe workers or whoever, that is existing also in your business, but they are not contributing to the business income. They are not making any income for the business. But they are also living or gaining or getting some things from the very business that they are not contributing to their human liabilities. And it's better to reduce the quantity of human liabilities you have and be able to raise your assets. Because at the end of the day on your balance sheet, after taking note of your capital, you are going to have a net asset. Your fixed asset comes first on your balance sheet. Your fixed assets, your cars, your building and everything. Let's say factory building, your vehicles, or you call it motor vans. In the old accounting books, they call it motor vans. Your fixtures and fittings, F and F. By the time you find the total of all these assets, then plus your current assets, your cash at hand and your cash in bank and cash in the thing. By the time you find the total of all this, if you are not careful, if you have more liabilities, you are going to discover that your net asset is going to be low. Because at the end of the day, you are supposed to compare the answer here with whatever you have here, which is the sum of your capital plus your liabilities, both long-term
and short-term liabilities. So if your liabilities, for instance, amounts to 10,000 and your capital is about 50,000, by the time you find the total of the liability, you got 10,000. If the total here is giving you 60,000 and the total of your asset here, if the total of your asset is giving you something higher than 60,000, fine, your business is good. It shows that you have a positive net asset. But if your asset is of lower figure compared to the total on this side, then there's trouble. That means your business is gradually becoming insolvent. And an insolvent business will likely liquidate. That means you're having more financial obligations to pay to outsiders than you have in your business. So this is where we should be able to look at the workforce. Whenever business owners complain to me that they are struggling with their profits, I say two things. The first one, you can increase your profit by reducing your price, your selling price, or you increase your profit by reducing your production cost. And bringing down your production cost, there are two types of production costs. We have the overhead and we have the prime cost. The prime cost, those are the direct costs, the direct labor, direct materials, and the direct expenses. You may not be able to alter those ones. You can't reduce the fuel you put in your vehicle to distribute your goods. If you do that, it will not cover as much distance as it should cover. You can't reduce the salary of your workers because you are trying to bring down costs. If you do that, their own productivity also will reduce. You can't touch prime costs, but you can work on overheads. You can look at the amount you are spending on recharging your communication devices. You can look at the amount you are spending on paying PACM bill. You can look at all those overhead costs and bring it down. If you reduce that, then your cost of production is reducing. And by so doing, if your cost of production, your total cost, if your cost of production reduces, if you can reduce your cost of production and you maintain the same selling price, at the end of the day, your profit will increase. And I'm going to put it in an equation. Normally we say profit in the elementary financial classes. We say profit is equal to selling price minus cost price. And so, if my selling price remains the same, and I'm able to reduce my cost price, let us say my selling price is 10,000, and my cost price that used to be 8,000, I'm able to reduce it to 6,000. What will happen to my profit? My profit this time around will become 4,000, as against the 2,018. So to solve business problems, actually, look at your liabilities, look at your assets. If you have some idle liabilities that are not productive and they are not bringing any profit, remove them. Reduce the liabilities, increase the asset. And even when you are increasing the asset, make sure you are not increasing properties that are not assets. Not all business properties are assets. Only the ones that are used for business purposes are assets. If you go and increase the fleet of cars that you work for your managers, and you reduce the number of vehicles that are distributing your goods, you are increasing assets, you are increasing properties and not assets. Because the fleet of cars will not bring direct income for the business, but the vehicles that are distributing the goods will bring in direct profit. See you in our next class. It is Great Impacts Multiventures Ltd-Making. Thank you. Have a nice day.